how does this story end, and how does it impact a hub like Hong Kong, which in the past has really benefited of being a gateway to the West and a gateway to Beijing?
Well, Hong Kong in general, obviously the whole world will be affected by this, and I feel that there will be a huge problem as a slowdown will come about if once this 200 billion tariff comes into being. I think that in general, Hong Kong has in the past number of years turned into a service economy, which in effect less driven by exports. Shanghai, as the ports in Shanghai, has usurped Hong Kong's port as number one from China. Hong Kong is number two. But I think that Hong Kong in general, the world will feel it, and obviously Hong Kong, along with all services, will feel it as well.
Yeah, specifically, if you take a look at, you've got to presume that if this trade war worsens, you're going to continue to see a stronger dollar and you're going to continue to see a depreciating yuan. How do you expect that's going to play through to the level and the sort of power of Chinese consumers spending in places like Hong Kong and Macau?
Well, we can already see because of the Hong Kong is tied to the U.S. dollar and because the depreciation of the yuan, of the currency in China, last month in July, we had single-digit figures for Chinese tourists coming to Hong Kong. So there already was a slowdown because goods in Hong Kong become much more expensive. And so in effect, it's a knock-on effect, and that affects all services, consumer products, hotels, food and beverage, you name it. And obviously, in one way, there's a silver lining at the end. It will affect the property market. The property market in Hong Kong has been the highest it's ever been. And in effect, what the increase in the interest rate will do is make the property market come down. And I think that will make a lot of people in Hong Kong happy. The life has been hard for the have-nots in Hong Kong. And I think that, as happened all over the world, I think that in a way it'll be a readjustment. And Mother Nature always has a way of readjusting things. And I think that in the end, we'll go back. I think, hopefully, the trade war will come to an end because free trade has been the bellwether of the world. It's created jobs. I mean, the thing I find pretty funny is that Trump says that trade has caused job losses in the U.S. and the previous administration that caused these trade wars were like babies, according to his words. But on the other hand, if you look at the unemployment in the U.S. with these trade laws and everything, it's at the moment it's everyone's working, and so where does that argument get him? I don't think he really understands world trade, and I think technology, they said, was a disruptor in the world. I think U.S. is more worried about China becoming a dominant power in technology. The 2025 Made in China motto that President Xi had brought out before, I think that kind of raised the eyebrows of many people in the United States. And I think this has suddenly become, the trade war has suddenly become the next thing on the horizon. I believe that he will raise the 200 billion thing that he's talking about, and I believe it'll eventually go to 500 billion, and then it's not just, as we see, not just China, but it'll be Japan, it'll be the EU, around the world, where we will slowly see the world will go into some kind of a stagflation or something like that.
And in fact, you know, speaking of how investors react to what the president says and does, we're just looking at these live pictures there of President Trump attending a campaign rally in Billings, Montana. Amongst some of the things he's been talking about, he's saying that unelected deep state operatives are a threat to democracy. So perhaps reacting to Bob Woodward's book, as well as that now infamous op-ed, the anonymous op-ed in the New York Times as well, talking about the lack of stability within the Trump administration. Alan, what do investors do in this situation where a tweet, maybe an editorial from Beijing can change confidence as to whether you should be investing pretty much anywhere in the world?
I think investors are starting to live with this disruption that's happening around the world because of the president, because of the United States. Everyone used to look up to the presidency of the United States. That was like the ultimate, everyone's dream was to become president. And I think that what's happened now is around the world, countries who used to look up to the United States are suddenly looking at finding a way that they can do their own thing. And I think that for investors, I think that obviously disruption is opportunity, and for many people, and I think it's just gauging, every day living in this world today, every day is with the Twitter comments every day. You're living, you're walking on a tightrope, and so I think that investors really need to be cautious. They need to look at what's going on. The last 14 years, it was a no-brainer. You just invested your money in anything, and everything went ahead. Looking at technology, that is the future, and I believe that. But there will be a slowdown in consumer buying around the world, I believe, and so that's just something that we've lived with before, and we'll just have to make adjustments, buy on the dips, and you'll get these slight improvements. But I don't think it can continue the way it's been going. The market is way too high.
What about the power of the domestic Chinese consumer? That's been part of the narrative for a long time, the rebalancing to domestic demand, right? Do you think that's strong enough to create opportunities to make up for these external, chaotic events that Beijing is trying to work its way through?
Well, what they're saying is by 2020, you'll have 500 million Chinese consumers, a middle class, and that's almost double the United States. And I think that the idea with China, because of their economy, they can pump more money. They can loosen credit, which they've done before, have more infrastructure being built. They can keep the economy going. I think U.S. consumers will be much more affected by this trade war than the Chinese consumer. I think that they know how to buckle down if they need to. But I was in Guangzhou yesterday, came out of China yesterday, and there is a feeling, yes, there is a slowdown. People are talking a bit about the trade war, but in general, if you walked in the streets, you didn't see anything. I mean, it was, and I know it's early stages right now. We'll see what the 200 billion tariff does to the Chinese economy, but I really feel that China has all the tools to make things happen. They're now also talking about RCEP, which is a new trade agreement without the United States, with about half the population, which is RCEP is it'll be voted upon in November. It's the ASEAN 10 ASEAN countries with 6 countries in Asia, including Japan, that's just said that they would take part. So I think that in general, China's looking at other alternatives in case this continues for a long time.
Alan, just to get your final thoughts on the malaise that we've seen when it comes to Hong Kong equities, do you think this is persistent? Do you think it's just because of linkages to China? And do you think that there's an extent there's sort of developing investor concern over the political linkages that Hong Kong has with Beijing?
I think it's a combination of both. I think you had a lot of, the Hong Kong market was very, very hot for a long time because you had a lot of free capital coming into Hong Kong. And I believe that obviously all these things that are happening around China, around Hong Kong, the rhetoric affects a lot of sentiment, and I think a lot of money has been leaving Hong Kong, and that's probably why you've seen a sell-off of the market. The economy in Hong Kong is still pretty good, and as I said, it's a service economy, and I think it'll continue, but the market will adjust and get ready for the next rise.